$1 million, if you put it in the S&P 500 35 years ago and forgot about it, it's worth $26 million today without you doing anything. If you put it in private equity, you have 139 million in the same time with the same amount of money.
Unbelievable. Private equity is crushing the S&P 500, just like Tony said, but a lot of people are like, what is private equity and how does it even work? In today's video, I'm gonna break that down. What is private equity? What are the strategies they use? How are the funds structured? And how can you invest in it? I'm Matt Sorensen. Let's build wealth. So let's talk about first, what even is private equity? Now, what private equity is, this is a class of investing where people will go and buy existing businesses, try to turn them around, improve them, grow them, acquire other companies with them, and then go sell them to someone else for a higher price or possibly take them public. Now, this is very different from venture capital or hedge funds. I want to make sure everyone understands the difference of these things, okay? Because a lot of people use these terms interchangeably, but they are very distinctively different things. So let me try to break this down, the difference between those three different categories you hear often. Venture capital. Venture capital is all about startups. This is companies that don't even freaking make money yet or have a product. This is people investing in very new early companies. That is what venture capital is. Most of those companies fail, but there could be one that goes 1000x and becomes the next Uber. That is not what we're talking about today. Next is private equity. Private equity is what we're talking about today. This is existing businesses, but they're private companies. They're not publicly traded. They're not significantly large companies typically. They could be, but what they're doing with private equity is they're looking at companies that are existing, profitable, and they are trying to go buy them and grow them. So these private equity fund operators think, hey, we can go improve that company. We think that's a growing area. We can go merge that company with another company. There's a lot of strategies we'll get in here to in a second, but private equity at heart is existing businesses that are profitable, trying to grow to become more profitable to sell to someone else for a higher profit. Now, hedge funds have nothing to do with this. Hedge funds are people who basically have a fund of money and who go trade the stock market or their publicly traded assets typically for profit. They're not buying businesses, trying to improve them and grow them. They're short-term gains. They're typically people who are traders. Again, not what we're talking about today. Now, let's go over some of the strategies that private equity use. Now, there's two primary types of private equity companies and strategies that they will deploy. One is called buyout. And what a buyout private equity fund does is they go and buy out the existing owner of the business. Maybe it's a family that's owned that business or some partners or an individual, some founders, whatever it may be. And they're like, we want to be done. We want to sell this business. We're going to go sell it to private equity. And what's private equity going to do? They're going to bring in a professional management team to go run and grow the business, hopefully turn it around to make it more profitable than it was before they bought it, and go sell it to someone else or possibly take it public to go realize the gains from that increase in value of the company. It's kind of like someone buying a fixer-upper house. They buy it at a low value, they fix it up and make it more valuable, and they go sell it for a profit. That's what private equity is doing. They're just doing it with businesses. They're buying businesses at a discount, trying to find value there, improving it, and selling it for a profit. Now, the second type of strategy that private equity uses is called growth equity. Now, what growth equity is this is when a private equity firm comes into a business that they like and they say, hey, if they had a little bit more money, we can inject some capital into the business. We're going to get some ownership for that, but if we just inject some capital for it, let's leave these founders in place, let them try to grow the business with our additional capital. Maybe we make some acquisitions, maybe we go hire some people that they needed, buy some equipment or whatever things the business might need to grow. And then as that business grows, it becomes more profitable. Again, we can sell it for a profit later. They're not taking over the business and buying it out. They're kind of coming in and partnering with their money to help that company grow and then again, sell and get a profit later on. All right, now what does this mean for an investor? Well, the nice thing about this for investors is private equity companies have funds. They have funds that they go raise capital from investors and they go use that money to go buy out these businesses or to put in growth equity capital to them, again, to help them grow with the hope of selling that company later for a higher profit. So how do you participate as an investor in that? We're going to come to that in a second, but I want to explain the fund structure first so you understand what you're actually getting when you invest in a private equity fund. Now, in a private equity fund, you have two pieces. You have GP, which is the general partner. This is the people that run the private equity fund. They're called the general partner or manager. They're operating the fund and they're in control. And you also have LPs or limited partners. This is you if you're investing in a private equity fund. You're considered a limited partner. You're investing capital. You don't have a vote or say of what's going on, but you're along for the ride whether they make money or they lose money. So you would be an LP if you were investing into a private equity fund. The GP, those managing it, again, are going to have all the control and the responsibility to try and turn a profit. They're going to determine what companies they go buy or they invest in, and then they're going to determine what they sell them for and who they sell them to. You're along for the ride simply as as a limited partner. Now, generally, what does the general partner get? They typically get something called 2 and 20. This is a common fee structure in private funds in general, which means they get 2% of assets under management and 20% of any profits that are received. So for example, let's say there's a $100 million private equity fund. What does the general partner get for managing that fund every year? They get a 2% annual management fee. That annual management fee is covering their expenses, their costs, their salary, their diligence. They have legal work and accounting work and things that they got to do as they're buying and selling companies. And then there's the 20% profit interest, sometimes called the carry, that is when they sell a company or they realize a gain, or the company could even be receiving profits and distributions, then they're a shareholder in it, but they will get a 20% of the profit. Now, the investors are going to get the other 80%. We'll talk about that here in a second, but this is what it's in it for the general partner. Now, there's been more billionaires made in private equity than in any other industry out there, right? There's definitely more millionaires made in real estate, but there's more billionaires that have been made in private equity. Just look at the Forbes 400 list. How many people on that list are private equity company founders or people that started a private equity fund? They've been successful in raising capital, buying and selling businesses. And by the way, when they're doing this, they're not doing this for hundreds of thousands or millions of dollars. This is tens, hundreds, billions of dollars of types of transactions that private equity funds are doing. So there's a lot of money on the table, and you can see here, if someone's good at doing a private equity fund and they can turn a profit of 100 million or so, they get to keep 20 million of that. And if they didn't, they got a $100 million fund, they at least got a $2 million annual management fee for all their hard work. Now, how do you invest in a private equity fund? Well, first you have to qualify to invest in a private equity fund. There's securities laws that determine who can invest in these funds. From a securities law standpoint, government officials think that these are risky, and they can be if you invest in the wrong fund. Now, as Tony Robbins explained, they've delivered significantly better returns as an industry than as the S&P 500. But how do I actually get access to these? You first have to qualify. There's two different rules on this that private equity funds use. One is the accredited investor rule, and the other is the qualified purchaser rule. So let's go over the accredited investor rule. This is much more common. The qualified purchaser rule is sometimes used on much more exclusive funds or larger funds that might only take like $1 million minimum investment. Now, the accredited investor rule says you can invest in a private fund so long as you have $1 million of net worth. Now, that doesn't include the equity in your personal residence. That could include your IRA, your 401k, your brokerage account, other rental properties or other assets, even business assets. You can use that to qualify with the $1 million net worth. Or you can qualify because you have $200,000 annual income if you're single, or $300,000 in annual income if you're married. Now, if you qualify as an accredited investor, either because of your income or your net worth, now you can have access to private funds, including private equity funds. Now, some private equity funds are going to say, no. We don't take only accredited investors. We make you be a qualified purchaser. And the qualified purchaser rule says you must have $5 million of investable assets as either an individual or as a family holding company. Again, this could be brokerage account, this could be even retirement accounts, this could be rental real estate, but it's investment assets that you own. If you have $5 million of that, then you can qualify as a qualified purchaser. Now, a lot of people are not a qualified purchaser and they're not at that $5 million mark. What's happened is more and more people are qualifying actually as accredited investors and under this rule. And there's a lot of private equity funds that take money from accredited investors. Now, most private equity funds are going to have a minimum investment of at least $50,000. This is not something you're going to put $5,000 or $10,000 in. They don't want to waste their time. They want to make sure you're going to be invested in it. And this is different than just clicking a ticker on a computer to go buy publicly traded stock. There's more paperwork and accounting process. So these funds want to make sure they have people who have enough invested to make it worth their while. Now, I personally invested in some private equity funds. They had a minimum investment of $250,000. At our company directed IRA, where people use their IRAs to invest in private equity funds and private funds all the time. Sometimes they'll make exceptions to their minimum, but I would say on average, the private fund minimum investment amount is about $100,000. Because you see 50K a lot, sometimes you'll see 100, sometimes you'll see 250. It's rare you'll see the million. These are the very exclusive funds that only market to the ultra high net worth people. But if you're like, I want to get in the private equity game, can I do it? If you're an accredited investor, you at least have 50K, it's possible. If you have 250K, it's a little easier. Now, a lot of people are like, well, Matt, where do I go? Guys, private equity funds, you can't just buy on your Fidelity account or your TD Ameritrade account. There's not websites where you just go buy a private equity fund or you go research them, okay? They are typically private, all right? You need to network. You need to find people. You need to learn about private equity, learn about private fund opportunities. This is the same for venture capital and the hedge funds I talked about earlier, okay? This is kind of who you know. Now, we have our Alternative Assets Summit, by the way, every year. This year, it's October 24th and 25th in Scottsdale, Arizona. We'll have topics on private equity, venture capital, oil and gas private investing, multifamily and commercial real estate private funds you can invest in, and people who have expertise in this. And these are places where you can go to learn about this. Now, the lazy tip I'll give on this is if you're like, man, I don't like meeting people or going out and networking, that's just not my thing. Go get a financial advisor that has an expertise in alternative investments. There's a number that we work with. They can get you access to private equity funds. Because there's a lot of private equity funds that'll say, hey, we'll take money from accredited investors. We'll let them invest in our fund, but they gotta have a financial advisor because I don't want to babysit them. I don't want this person to ask me a million questions. They can ask their financial advisor. And that financial advisor a lot of time aggregates some of the other clients that might invest in this fund or their firm. Now, I'll say this about private equity. You can invest in a crappy private equity fund that doesn't offer great returns. And actually, this year, private equity's had kind of a tough year. Now, over the long haul, in the last 20, 30 years, as Tony Robbins was explaining, they've done phenomenally. It's like been the highest producing return asset class out there, period, has been private equity. But you still got to make sure you're choosing the right private equity funds. They have the right management and leadership, the right strategy you believe in. They're going to protect your funds. They got the right legal and paperwork and process being done. And so as an investor, you still, of course, got to do your due diligence. Now, please subscribe to the channel. I'm giving tips every day on how to build wealth, making great investments, building your retirement account, saving taxes, protecting your assets. I'm Matt Sorensen. See you next time.